Good morning. Today we are going to start our business accounting class for BBA, same to section C. Now today we are going to start a new chapter, final accounts. Now final accounts for the proprietorship companies and final accounts and trading and profit and loss accounts and balance sheet. So since most of us are new to that, we'll have one or two introductory classes on the elements of the balance sheet. Now balance sheet is one of the most important financial statements. Now, balance sheet and trading and profit and loss. Now, balance sheet can be depicted in two different ways. One is the horizontal, and the other is the vertical statement. In one format, we have both the assets and the liability side taken together in the landscape format. However, in the one we have the portrait format. That is, we first have the asset side written, and then we have the liability side written. Now, as you can see, the balance sheet generally we have the asset sides on top in case of the normal single fashion. And then, however, in case of your examination, you have to write both the assets and the liability side together in the single uh, on both sides, and not on the not in the single manner. That is first assets and then liability. Now we can see the balance sheet shows all the assets on top. That is first the assets are written and then all the liabilities and the shareholders' equity are shown on below the assets. Now what do we mean by shareholders' equity? Shareholders' equity is the amount that is introduced by the promoter or the owner or the person who has started in the company. Now the person who has started in the company, and they have on the asset side of the balance sheet, the assets are what the company owns. Now a company, or in case of the sole proprietor, what the company owns. And this section of the balance sheet tells you what kind of the assets the company owns. What kind of assets means, say, what are the fixed assets, what are the current assets, how much, what kind of fixed assets the company owns, what kind of current assets the company owns, and what are the specific values of these assets. Now, all values are transferred into money or its worth. So, all values are transferred into monetary values, and then it is taken together and represented. Now we have elements of the balance sheet. Now we have current assets. The current assets includes cash, accounts receivable, marketable securities, inventory, and prepaid expenses. However, what we this should be convertible into cash in the near future. However, the time period for distinction with for to be in current assets is that it should be convertible within 1 year. Now, cash includes amount in cash and at bank, and also includes short-term deposits or investments that the company makes from time to time when it has some excess cash in hand. Short-term investments may range from 7 days to say 32 days to 45 days, and is readily convertible into cash. Now, accounts receivable. Accounts receivable are the sundry debtors or the amounts that are obtained by the company from credit sales. We'll deal with it in detail short time from now. Now, marketable securities. What are marketable securities? The company has made some investments in some stock market or some bonds and all that, and the company can quickly sell those bonds and earn the cash. Now we are going into the next portion, that is the relevance of the current assets. The current assets, we have cash and cash equivalent. The first kind of the assets are the most liquid. These kind of assets are the most liquid. What is the most liquid assets? Cash that is readily available to us, and a cash equivalent, the amount that is for the sundry debtors. The amount that is for the sundry debtors. Now, no, sorry, cash equivalents. So cash equivalents here also means the say the short-term investments that the company makes, amount in bank, and also the investments made by the company in shares or bonds, as previously said, which are readily sellable in the market, and the company can get back the amount in cash. Now, why does the company make these investments? To earn some extra profit with the idle cash, which it cannot readily invest back or plow back into the business. Now, the accounts receivable. The accounts receivable refers to the money due from the company from sales to consumers. Now, as we know, we generally follow the actual system of accounting. What is the actual system of accounting? The actual system of accounting actually is the amount that is sold by the company for the goods or services that is sold by the company to its entities. Now, these accounts receivable are also known as sundry debtors. Now, sundry debtors, under sundry debtors, we have individual ledger accounts for each and every person who has brought the things for a from credit from the organization. Now we have found the amount in total sales. We deduct if we have any goods or returned. We deduct if we have allowed any discount. The rest amount is payable by that particular consumer who has obtained the goods on credit. And as and when the payment is made, and actually deduct this amount from the amount due from the consumer. Now, this cycle actually carries on because generally the persons who buy goods on credit, they have a continuous relationship with the company, and they actually buy goods in credit, and they actually pay for the previous purchases made, and so on. Now we also have the inventory. Now, what is inventory? Inventory means the raw materials or the work in progress of the finished stuff. Now, what are raw materials? Raw materials are the amount that the company purchases from the vendors or the suppliers, and if the process is this, now we know, as we know, production is the process of converting raw material, irreversible process of converting raw materials into finished stuff. Now, in case this is specifically in case of companies in manufacturing industry, the raw materials are obtained by the particular uh, uh, company. The goods are processed by that company. Now, however, as we know that the financial year for a particular company starts from April to March. However, the company may have obtained in a certain day, as say as on 31st March, all the raw materials will not be converted into finished goods, and the finished goods will be under three different formats. Now, it might be say 30% finished, three or four different formats. It might be 60% finished, it might be 90% finished, or it might be in several other stages of completion. So we have that under work in progress. Now we have finished stuff, that is goods that have been completely converted by the company, but the company has not sold these goods, and they are in the finished stock of the company. Now, prepaid expenses. What are prepaid expenses? These are expenses that the company has paid ahead of time. Now, these expenses are mm, mm, provided by the company. Uh, uh, these expenses are provided by the company. Say, for example, the insurance expenses. Now, say the company has paid the insurance policy for the period from January to June. However, the financial year is from April to March. So the company in this current year can only show in the trading and profit and loss account the amount paid from for January. So the insurance premium paid for the period of 3 months from January to December, from January to March. However, the period from April to November will have to be April to December will have to be April to December will have to be shown by the company as the prepaid expenses, as the amount has been prepaid before the amount has actually become due, and it will be shown in the accounts of the in the balance sheet of the company as a prepaid expenses. We will continue with this section and the rest section of the introductory classes of trading and profit and loss account in our next session.